Bank of America collapses. Not in headlines, not on your trading app, but quietly inside its own research notes. The same institution that dismissed silver for decades, the same bank that warned clients to stay away, has now issued an alert that changes everything. A number so extreme it doesn't signal opportunity, it signals failure, a price that doesn't predict profit, it predicts stress, and a warning that wasn't written for the public, but accidentally leaked into it. This is not about silver going up. This is about something breaking underneath the system. And once you see it, you cannot unsee it. Because when banks stop controlling narratives, they prepare for consequences. And what comes next is what they're afraid to say out loud. Welcome to John AG. If you're watching this, chances are you're someone who values experience, patience, and hard-earned wisdom. If you're over 50, you already know one truth. Systems don't warn you loudly before they fail. They whisper. So subscribe, not for excitement, but so you don't miss the whispers that matter. And before we begin, tell us something important in the comments. The warning did not come with sirens. It did not come with breaking news banners or emergency press conferences. It came quietly in the language of research notes and portfolio guidance. That is how serious signals always arrive. When institutions panic, they do not shout. They reposition. On January 6, 2026, a line was crossed. One of the most powerful financial institutions in the world, Bank of America, reversed a position it had defended for years. For decades, this institution treated silver as a marginal asset. It discouraged ownership. It framed precious metals as insurance at best and distraction at worst. That posture was not accidental. It reflected how the system worked. Large banks do not speak casually about commodities. Their words shape capital flows. Their research guides pensions, insurers, and corporate treasuries. When such a bank changes its view, it is never about optimism. It is about exposure. This is why the current alert matters. In normal times, banks encourage stability. They promote diversification models built on stocks and bonds. Metals are assigned a small role, often less than 5% of a portfolio. This framework assumes that markets are liquid, that prices reflect reality, and that supply is always available at some level. That assumption is now failing. When Bank of America raised its internal outlook dramatically, it was not chasing momentum. It was responding to stress. The bank was signaling that the old models no longer describe the world accurately. This is the first principle that serious observers must understand. Institutional capitulation does not happen at the top of a cycle. It happens when risk can no longer be controlled. The shift was not subtle. Gold, once dismissed as overvalued, was suddenly framed as essential. Not optional, essential. The suggested allocation jumped from traditional levels to a range that implied fear, not confidence. Such a move suggests that the bank sees danger in the remaining portfolio. Stocks, bonds, and currencies were no longer enough, but silver was the more revealing signal. Silver occupies a strange position in the financial system. It is both a monetary metal and an industrial input. It is used in electronics, energy systems, medicine, and defense. Unlike gold, much of it is consumed. It does not return easily to the market. This makes silver sensitive to supply stress in a way that most assets are not. For years, banks treated silver as abundant. The paper market made it appear so. Futures contracts multiplied supply on screens. As long as few people asked for delivery, the system functioned. Price stayed contained. Confidence remained intact. That equilibrium has ended. Bank of America's alert acknowledged something it could no longer ignore. The numbers no longer balanced. Historical ratios, geological data, and industrial demand all pointed in the same direction. The price implied by the paper market no longer matched the physical reality underneath it. This is the key insight. The alert was not about forecasting profits. It was about acknowledging constraints. Large institutions model risk across time. They stress test scenarios. They ask what happens if supply tightens, if delivery fails, if counterparties demand performance instead of settlement. When those scenarios move from unlikely to plausible, institutions act. This is what happened here. The bank understood that silver supply is not flexible. Mines cannot respond quickly to higher prices. New production takes years to develop. Much of the existing supply comes as a byproduct of other metals. When economic conditions change, silver output can fall even as demand rises. This creates a structural problem that price alone cannot fix. From an institutional perspective, this is dangerous. A market where price discovery relies on leverage rather than inventory is fragile. Once confidence breaks, leverage works in reverse. Small shortages become large shocks. That is why the alert used strong language. Not dramatic language, but decisive language. It reframed silver from a speculative asset into a strategic one. That shift alone signals that the institution believes availability will matter more than valuation. History supports this interpretation. In past cycles, major reversals by large banks marked the end of suppression, not the beginning of enthusiasm. In 2008, institutions changed their language on liquidity just before credit markets froze. In 2020, central banks altered policy guidance shortly before bond markets required intervention. In each case, the public explanation followed the internal decision. This pattern is repeating. The warning from Bank of America was not designed for retail investors. It was written for clients who manage risk at scale, for people responsible for preserving capital, not chasing returns. When such an audience is told to increase exposure to a metal long dismissed, it reflects a loss of confidence in the system surrounding it. This is why the moment deserves attention. The collapse referenced in the title is not about a share price or a balance sheet. It is about a narrative. The narrative that silver was plentiful, controllable, and secondary has broken. When narratives collapse, markets reprice violently. The rest of the story explains why this shift occurred now, what forces made it unavoidable, and what it means for those who must make decisions in an unstable environment. The warning has been issued. The question is not whether it was justified. The question is what follows when institutions stop pretending that the old rules still apply. The problem did not begin with price. It began with availability. For decades, the silver market appeared calm on the surface. Charts moved up and down. Analysts debated trends. Traders watched indicators. But beneath that surface, the structure holding the market together was quietly weakening. The system relied on an assumption that was never tested at scale, that physical silver would always be available when needed. That assumption is now failing. Silver pricing in the modern financial system is not set by people holding metal. It is set by contracts. Futures, forwards, swaps, and options determine what most investors see on their screens. These instruments trade promises, not bars. They work only if those promises can eventually be honored. This system depends on confidence. As long as most participants are willing to settle in cash rather than demand delivery, the paper market can expand far beyond physical supply. This expansion creates the illusion of abundance. It keeps prices stable. It allows large institutions to manage exposure without touching real metal. But confidence is not permanent. When industrial users, governments, and long-term holders begin to prioritize delivery instead of settlement, the paper structure becomes fragile. Every contract is suddenly a claim. Every claim tests inventory. That is the point where paper markets reveal their limits. This is where the silver market stands today. Physical indicators began flashing warnings long before institutional reports changed tone. Premiums rose first. Not by a few cents, but by several dollars per ounce. Delivery times stretched from days to weeks, then months. Retail dealers reduced product offerings. Large bars became difficult to source. These were not price signals, they were supply signals. In a healthy market, rising premiums trigger arbitrage. Traders buy the cheaper paper price, take delivery, and sell into the higher physical market. This process closes the gap. It restores balance. The fact that this gap is not closing is the most important detail. It means delivery is not happening at scale. The futures market, anchored to exchanges like COMEX, was designed to manage price risk, not supply risk. It works well when inventories are deep. It fails when inventories are thin. The system was never built to handle a sustained demand for physical withdrawal. This mismatch is now visible. Warehouses report declining stocks. Categories of inventory once considered available become restricted. Eligible metal cannot easily be converted into deliverable supply. Each layer of complexity slows response time. Each delay raises risk. From a business perspective, this matters more than price. Manufacturers do not operate on charts. They operate on inputs. A solar panel producer cannot hedge away a shortage. A defense contractor cannot substitute a futures contract for metal. When supply is uncertain, procurement costs rise regardless of what the screen shows. This is why physical premiums are exploding. The premium represents reality. It reflects scarcity, logistics, and trust. When premiums rise faster than spot prices, the market is signaling that the reference price no longer clears supply. The paper price becomes informational, not transactional. At that point, price discovery breaks. Institutions understand this distinction. They track flows, not headlines. They watch inventory, not sentiment. When they see a persistent divergence between paper and physical markets, they recognize systemic stress. This stress explains the sudden change in institutional language. The alert was not driven by speculation. It was driven by breakdown. Analysts saw that even at higher prices, metal was not returning to the market. Supply elasticity was missing. Normally, higher prices encourage selling. In this case, higher prices encouraged hoarding. That behavior reveals fear. Holders of physical silver were no longer motivated by profit. They were motivated by protection. They preferred metal over currency. That shift alone destabilizes any paper-based pricing system. The breakdown also exposed a second weakness: concentration. Large volumes of silver production are consumed immediately by industry. Electronics, energy infrastructure, medical equipment, and defense systems require silver continuously. This demand does not pause during financial stress. In fact, it often increases. At the same time, investment demand rose. Individuals and institutions sought tangible assets as insurance against currency risk. Two demand streams converged on a supply base that was already shrinking. And this convergence is rare. It creates nonlinear outcomes. Banks and exchanges are equipped to manage volatility. They are not equipped to manufacture metal. When faced with a physical constraint, financial tools lose power. Margin adjustments, trading halts, and rule changes cannot create inventory. This is the environment Bank of America was reacting to. The paper price still exists. It still moves. But its authority is fading. The real market is migrating elsewhere into private contracts, long-term offtake agreements, and direct acquisition. As this migration accelerates, the visible price becomes less relevant. This is why serious observers must stop focusing on short-term charts. They describe activity in a shrinking arena. The larger game is being played outside that arena, where delivery matters more than liquidity. The silver market is not experiencing volatility. It is experiencing a structural failure in price discovery. The system that once balanced paper promises against physical supply is no longer doing so. What follows when that balance is lost is not gradual adjustment. It is repricing. Part 3 will explain why this breakdown is not isolated. It is being amplified by global liquidity forces and a growing divide between how different regions of the world treat money, assets, and resources. To understand why the silver market is breaking now, one must step back from the metal itself and look at money. Not money as a price, but money as a system of power, trust, and allocation. What is happening in silver is not an isolated commodity event. It is the consequence of a global liquidity shock that is reshaping how nations protect themselves. For most of the last 50 years, the global financial system followed a predictable pattern. Western economies printed currency, exported inflation, and absorbed the world's savings through financial markets. Capital flowed into stocks, bonds, and real estate. Commodities were treated as secondary. They were inputs, not anchors. That model depended on confidence. As long as currencies retained purchasing power and financial assets delivered returns, there was little reason to hold large quantities of physical resources. Paper claims were efficient. Liquidity was king. Storage was a cost, not a strategy. That logic is now being questioned. Over the past several years, global money supply has expanded at a historic pace. Central banks responded to crises by injecting liquidity into the system. This was not limited to one country. It was global. But the way that liquidity was used differed sharply between regions. In the West, newly created money flowed into financial assets. Equity markets expanded, debt markets grew. Valuations rose faster than productivity. This supported balance sheets but increased fragility. The system became more leveraged, not more resilient. In the East, a different strategy emerged. Rather than recycle liquidity into financial speculation, several countries prioritized conversion. Paper currency was exchanged for tangible assets. Energy, food, metals, and strategic materials became the focus. This approach treated money as temporary and resources as permanent. Silver sits at the center of this divide. Unlike many commodities, silver plays a dual role. It is essential for modern industry and historically linked to money. That makes it attractive during periods of monetary uncertainty. When trust in currency weakens, demand for silver rises from two directions at once. This is precisely what is happening. One of the most significant developments has been the scale of liquidity expansion in Asia. When observers examine the balance sheets of institutions like the People's Bank of China, they see numbers that change the equation. Trillions in new liquidity are not theoretical. They represent purchasing power that must be deployed. The critical detail is where that purchasing power goes. Instead of flowing into speculative markets, much of it is being directed towards securing supply chains. Governments and state-linked entities are acquiring commodities directly. They are locking in long-term contracts. They are stockpiling materials that underpin energy systems, manufacturing, and defense. Silver is not being bought for trading. It is being bought for control. This behavior creates a persistent bid that is insensitive to short-term price fluctuations. When the buyer is motivated by strategic necessity rather than profit, price becomes secondary. Availability becomes primary. Western markets are not designed to compete with this mindset. Futures exchanges respond to price signals. They assume that higher prices will attract sellers. But strategic buyers do not behave like traders. They do not sell into rallies. They accumulate quietly and continuously. This drains inventory without creating visible volatility at first. By the time the effect appears in prices, the supply has already moved. This explains the growing divergence between Western paper markets and Eastern physical markets. While futures prices fluctuate within familiar ranges, physical metal is being removed from circulation. Refiners prioritize long-term customers. Warehouses see outflows that are not reversed. The result is a slow-motion squeeze. Western institutions are now forced to confront a reality they long avoided. Liquidity no longer guarantees access. A world with abundant currency but limited resources behaves differently from a world with balanced growth. This realization changes institutional behavior. When banks like Bank of America reassess silver, they are not reacting to sentiment. They are responding to geopolitical math. They see that resource accumulation is becoming a tool of national strategy. They see that supply chains are being weaponized. They understand that metals once considered marginal are now central. For businesses and investors, this shift has profound implications. Capital allocation decisions based solely on price history become unreliable. Risk models that assume frictionless markets break down. Exposure to assets that depend on continuous liquidity becomes more dangerous than exposure to assets constrained by physical limits. Silver's role evolves in this context. It becomes less about return and more about resilience. This is why the East-West divide matters so much. It is not about ideology, it is about survival strategies. One side treats money as an end, the other treats it as a means to acquire real things. As long as these strategies coexist, tension builds. The silver market is one of the first places where that tension becomes visible. It reveals how quickly paper systems can lose authority when confronted with sustained physical demand. It shows how liquidity can become inflationary, not through prices alone, but through shortages. The silver alert is not simply a call on a metal, it is a signal that global capital is being reoriented. Regions that convert currency into resources gain leverage. Regions that rely on paper claims face constraint. The focus will shift from systems to decisions. What this realignment means for businesses, investors, and capital allocation will determine who adapts and who is caught unprepared as the old assumptions fail. By the time institutions acknowledge structural risk, the window for easy adjustment has already closed. That is the final lesson of this cycle. What remains is not prediction, but positioning. Part 4 brings the analysis to its practical end. What this breakdown means for businesses, investors, and decision makers who must operate in an environment where assumptions no longer hold. The most important shift is the definition of risk itself. For decades, risk was framed as volatility. If prices moved too much, that was danger. If markets were calm, that was safety. This logic worked only because liquidity was deep and supply chains were reliable. In today's environment, volatility is no longer the primary threat. Scarcity is. A business can survive price swings. It cannot survive a lack of inputs. Silver exposes this truth clearly. When physical supply tightens, production schedules break, costs rise unpredictably, contracts fail. Even firms that do not use silver directly feel the impact through energy systems, electronics, transportation, and defense-related industries. What appears to be a commodity issue quickly becomes an operational one. This is why institutions are changing behavior. Capital preservation now outweighs return maximization. In late-cycle environments, this shift is decisive. Large actors reduce exposure to assets that depend on continuous confidence. They increase exposure to assets that retain value when trust erodes. This is not fear-driven behavior, it is rational adaptation. For investors, the implication is uncomfortable but clear. Traditional diversification models assumed that assets were uncorrelated. Stocks behaved one way, bonds another, commodities a third. In stress events, those correlations now converge. Liquidity risk binds them together. Hard assets behave differently. Assets with no counterparty risk do not depend on promises. They do not require settlement. They exist outside the financial system's balance sheets. In an environment where delivery matters more than price, these characteristics become strategic advantages. This is why silver's role has changed. It is no longer treated solely as a trade or hedge. It is increasingly treated as a reserve asset by those who understand supply constraints. When an institution signals that a metal must play a larger role in portfolios, it is not forecasting upside. It is acknowledging fragility elsewhere. Businesses face a parallel decision. Procurement strategies built on just-in-time delivery and price optimization are vulnerable. When supply chains tighten, the lowest price becomes irrelevant. What matters is continuity. Firms that secure long-term access to inputs outperform those that chase spot pricing. This applies beyond manufacturing. Technology, energy, infrastructure, and defense all rely on materials whose supply cannot be expanded quickly. In such sectors, financial engineering cannot replace physical planning. The silver alert reflects this reality. Institutions see that price signals are lagging indicators. By the time the market reprices fully, access may already be gone. This creates a first-mover advantage for those who act early and a penalty for those who wait for confirmation. Waiting feels safe. It is not. In systems under stress, delays compound risk. Decision makers who demand perfect clarity often receive it too late. This is why institutional shifts are important. They reveal where risk managers see danger before it becomes obvious. Another critical implication is the breakdown of trust in reference prices. When paper prices diverge from physical availability, businesses and investors must choose which signal to believe. Those who rely on screens may misjudge exposure. Those who monitor inventories, premiums, and delivery terms gain a clearer picture. This distinction separates participants from spectators. Strategic actors do not ask, "What is the price?" They ask, is it available? This question becomes dominant when supply is constrained. It explains why hoarding replaces trading and why markets can reprice suddenly rather than gradually. For entrepreneurs and business leaders, this period demands a shift in mindset. Growth strategies based on cheap capital and abundant inputs face pressure. Resilience strategies based on control, redundancy, and tangible assets gain importance. Balance sheets must be evaluated not just for leverage, but for vulnerability to supply shocks. This does not mean abandoning innovation or expansion. It means grounding them in reality. Silver's situation is a case study, not an exception. It demonstrates how quickly a system can move from stability to strain when physical limits are reached. Other materials will follow similar paths as monetary expansion collides with finite resources. The warning embedded in this alert is therefore broader than one metal. It is about a world transitioning from financial abundance to material constraint. In such a world, those who control resources gain leverage. Those who depend on promises lose it. This transition is uneven, uncomfortable, and often denied until it becomes unavoidable. The final implication is personal for individuals responsible for capital. Whether at an institutional or personal level, the question is not whether change is coming. It is whether positioning reflects that change. History shows that wealth transfers occur not through speculation, but through preparedness. Those who recognize structural shifts early preserve optionality. Those who ignore them are forced to react under pressure. The alert from Bank of America was not an isolated opinion. It was a signal from within the system that the environment has changed. Physical constraints are asserting themselves. Liquidity is losing dominance. Availability is becoming power. The story does not end here. It accelerates. For those paying attention, the task now is not analysis, but execution.